Welcome to the B.F. Anderson Technical Report for June the 9th. Warren Buffett, Robert Hagstrom wrote this book after he and Bill Miller over at Legg Mason attempted and successfully attempted to duplicate Warren Buffett's investment strategy, which is called focus investing. I recommend this book highly. What Buffett basically is saying is that one of the biggest mistakes that people make is they dabble in tips. And if you look at what Jesse Livermore has to say, he says, I know from experience that nobody can give me a tip or series of tips that will make more money for me than my own judgment. You know, with CNBC and the financial media and the media on the internet, you can get more tips than I've ever seen before in my career. And it's a big mistake. You really need to have a specific strategy to select stocks. I thought this was an interesting article. This was by Morgan Stanley's co-president, Ted Pick. And he's basically saying that we're involved in a paradigm shift that has begun. And what he's really saying is that, you know, the period of low interest rates has basically come to an end. As you can see by this graph here, I went back 15 years, and this is the yield on the 10-year Treasury note. And you can see, you know, it's been dropping and dropping, and then finally broke the resistance line, you know, pulled back during the pandemic. But interest rates are moving higher. And so basically what he is saying is that the next cycle, the next business cycle, will be primarily led by companies that really don't need to use debt on their balance sheet and basically have a business plan that allows for just profitability. Now, one of my favorite indicators, and I hate to use the word favorite, but one of the most successful indicators that I've been using over the last several years has been what I call the aggression index. I went back and looked at the market low in 2002, 2003. This was after the dot-com bust. Now you can see here where the aggression index, which is a ratio of the NASDAQ compared to consumer staples. You can see that, you know, it came down and made a low in October of 2002. Then we got what we call a golden cross, where the 10-week moving average crossed above the 40-week moving average, and you know, off we went. So this indicator is also very good. It was good at picking the market's top, but also it's good at picking market bottoms. You know, to go back to the same period and look at what happened. So we got the buy signal back, you know, around, you know, March of 2003. But then if you were really paying attention, and this was kind of like a new business cycle that I was trying to talk about earlier in the video. Look at this. This is Apple, and this is May of 2003. So you got this, you know, you've got the aggression index going your way. The market's in an uptrend. And then all of a sudden, this company back in 2003 has a tremendous amount of buy volume come in, and you got what you call a gap up. This was a gap up in the price. So this is what you really need to be looking for during periods like this, because there's going to be new companies out there that are going to pop up, and it could look interesting. Now, on the current aggression index, just so that as you can remember back from what I was saying here earlier, that if you look at it, you know, back here in 2002, you can see the upturn. Well, this is where we are today. We have just now, after pretty much a waterfall decline in this ratio, is now at least flirting with the 10-week moving average. So really, just like back in, you know, 2002, 2003, we want to see this somewhat round out and start basing and then turn up. And actually, it would be very healthy if the 10-week were to cross above the 40-week. Now, just on the, I've kind of changed up our indicators a little bit here. We're just looking here at the NASDAQ. This is on a daily basis. You can see here that we've somewhat got of a double bottom here, and we're coming up over that 10-day moving average and trying to get going in an uptrend. Now, this is what we would call a cup with a handle, and the handle needs to hold, and it needs to break out to this side. So we're watching it closely. We continue to be cautious, though. Now, here's the S&P 500, kind of the same story. We're below the 200-day moving average. We came down, we've somewhat formed a double bottom, and we're coming up, forming the handle. We really need to break out to the upside here to get somewhat more bullish. Here are the three economic indicators. Interest rates continue to flirt with 3%. Price of oil has definitely gone back into an uptrend. There's a lot of talk about oil going to 150 a barrel. Well, it's around 120 now, and the oil stocks continue to be very strong. Here is the financial stocks. We had a pullback, a rally, kind of pulling back again. However, the new lows, the good news here is the new lows on the New York Stock Exchange have really started to dry up. So this is usually typical of when you finally run out of sellers, is what it boils down to. Now, on the sentiment readings, which is the bull-bear ratio, again, the historical average is 38% bulls, 31.5% bears. So your average is around 6.5%, which is up here at this blue line. We did see somewhat of a pickup to a -5 after getting all the way down to a -42.5. We got to a -5 last week. Now, that'll be updated this afternoon. Now, on trend strength, we continue to have problems there. We have improved a little bit, but kind of struggling in this area. Now, this is on the NASDAQ. Trend strength is a minor reading of 13%. Really would like to see that number get up around 50%. Here's trend strength on the S&P 500. Same thing as the NASDAQ. We're above that lower moving average, which gives us a plus 13%, but continues to somewhat struggle. We need to see this kind of action. We want to see stability. Now, on the VIX index, the VIX, the basic readings on the VIX, if you go back in time and look at, past market lows, we got up to readings of up over 35. Right now, we're around 23.96, which means that the VIX, according to what I feel, I think the market will really, really put in a capitulation bottom if we got to readings of like 40, but it's not going in that direction. Now, I just want to show here also, this is a junk bond fund. This is definitely in a downtrend. We got somewhat of a rally breaking down again. So, corporate debt is kind of becoming a difficult place to invest. Here's the price on the 20-year Treasury note. You can see here we started to see somewhat of an improvement, but breaking down again. As interest rates go higher, this fund will continue to decline. It's about to break to a fresh low, in fact. Now, on the top five, we continue to see big emphasis on the oil industry. This is Next Tier Oilfield Solutions. Somewhat of an uptrend here, looks very positive. These stocks really do look good. It's just that the oil industry can be so fickle. Here's Occidental, which has been one of the strongest oil stocks in the group, forming somewhat of a base here. We'll have to see what happens. This is Alpha Metallurgical. This is a coal miner. Again, coal has been, just like all energy, it's in a definite uptrend. However, what's the future of this? You have to really ask that question. Here's natural gas, which is Antero Resources. Very strong uptrend, very positive readings. Here's EQT, another natural gas producer. Again, strong uptrend. So we're continuing to see a lot of strength in the energy area. However, the market needs to broaden out. We need to see more technology. However, that is just not happening at this time. If you have any questions, please let me know. Thank you very much.